All right, now, welcome to this week's episode of DoubleLine Minutes. This is Mark Kimbrough here with Ryan Kimmel.
Yo, yo.
It is 10 a.m. Pacific here on October 31st. I'm going to kick it off by saying more important thing to me is I hope the Dodgers can pull off Game 6 tonight. But I want to wish everyone out there a happy Halloween.
Happy Halloween, Mr. Kimbrough.
Hey, you got any plans with the fam today?
Gonna go trick-or-treating.
Be safe out there, man. Jumping into the market for the week, we have the S&P up 50 bips on the week. This is led by two sectors. Only 2 of the 11 sectors are up this week. It is tech, that's up by 2%, and consumer discretionary is up by 0.7%. We got some laggards. We got the real estate sector down by 4.3 and consumer staples down by 3.7. But in general, this market this week was characterized by, I call it the big dogs. This is a large cap growth week. We had 5 of the Mag 7 report this week. And I think in general, this was just a heavy earnings calendar. But recapping some of the major equity markets here, the other sectors of the market, we got large caps as represented by the Russell 1000 up 0.3%, while small caps represented by the Russell 2000 are down 2.1%. It's, like I said earlier, growth up 1.6, value down 1.2, market cap up 0.5, equal weight down, call it just 2 flat. So it's just a narrow market. There's plenty of dispersion here in terms of, the winners and losers, but in terms of the ones that are carrying the overall index, it's pretty top heavy. And you know what, just kind of jumping into the week, I'm going to recap just kind of the timeline of it. I mean, Monday we started with, it seemed like a bit of a risk rally globally following the easing of trade tensions going on between China and US. Next couple days leading the FOMC, it was kind of a slow grind, and we'll talk about the FOMC later, but that seemed to be a bit of a moment where we gave up a bit of those gains, and we're clinging on to some of that Monday rise, but kind of Wednesday was the big pivot moment of the week. Let's move forward to fixed income. Again, mentioning the rates were up on the week. I mean, following the FOMC, we were down on rates across the curve, and post FOMC from the 3-month to the 30-year rates were up just about 10 bips across the entire curve. So your duration sensitive sectors would be down for the week on that. Let's recap some returns here. We got the ag down 0.5%, government bonds down 0.5%, agencies down 0.4%, and investment grade credit down, just call it 0.95%. Your non-traditional sectors, your shorter duration sectors, you got high yield credits, call it flat, down 4 bips. Bank loans up 0.3%, and emerging market bonds, a big winner, up 0.7%. And you know what? Actually, I want to take a step back real quick. This is the end of the month as well. I know we're not done with the day, but I want to briefly recap equities. Just similar story to this week, but we had the S&P up 2.1%, led by technology. Again, growth was winning, large cap was winning, similar story, but another strong month for assets. Going back to fixed income, month to date, again, it was another winning month for assets. The ag was up 0.66% with rates down across the curve. You had 0.6% up in governments, 1% agencies, 0.3% in investment grade credit. And again, your non-traditional sectors, you were up 0.2% for high yield, call it 0.45 for bank loans, and 2.2 for EM. So strong for risk assets in general. And let's move forward to commodities. A little quieter week for commodities with the BCOM only returning 0.2% negative. We had ags up 1.9 on the week, energy up 0.3. No movement out of industrial metals. Precious metals was down 2.8, dragged down by gold. Seems like we're digesting some of that movement now. We're sitting just below 4K at the time of this recording. Seems, after such a big run up, it seems reasonable for us to have a little digestion moment here. Look, gold for the month, it's up 3.5% still, even though it's down this week 3.4%. And that leaves us with a gain of 49.8% for the year. And I'll close it up this week for, we had Bitcoin coming in at 108.5K, had a little vol there, but it's down on the month as well by about 5%. And that kind of closed up the week, unless you got anything to add, Kimmel.
Yeah, I mean, even though the government was shut down for the 31st day, 1 month into the government shutdown, yeah, as we mentioned, it was kind of busy just with earnings seasons. I think 44% of the S&P 500 market cap reported this week. In aggregate, it was, I think, better than expected, than many of the analysts had expected, but there was a lot of dispersion that was going on under the hood. You mentioned briefly the Trump-Xi meeting in South Korea. It's interesting that this was, the first time these two leaders have met in person in Trump's second term. I thought one of the headlines from President Trump was funny. As a follow up, he said it was an amazing meeting on a scale of 0 to 10, with 10 being the best. This meeting was a 12. So Trump came away from the meeting pretty positive. We did get some, I think it removes some of the tail risk of further trade war escalation. We saw like the fentanyl tariffs. The U.S. took those down in half from 20% down to 10%, and that led to a weighted tariff rate for China coming down to 35% from 45% earlier. We did get China to delay some of the rare earth export controls by 1 year, so that was taken positively by the market. And then on the U.S. side, we delayed our export controls on tech-related exports, and China agreed to purchase some soybeans from us. So by and large, I think it was taken pretty positively. Definitely reduces that tail risk of further trade war escalation. But really the main event of the week was the FOMC meeting.
Yeah, well, we'll get into that after we cover the eco data for the week, the limited eco data that we have.
Yeah.
On that note, do you want to jump into it?
Let's do it. So, as I said, the main event for the week was the FOMC meeting on Wednesday. I think coming into this week, the market really wasn't expecting much in the way of any surprises. But the Fed did cut as expected, 25 basis points to 4% upper bound. There were two dissenters. Schmid voted for a no cut. Mirren, as you would expect, voted for a 50 basis point cut. The QT was announced to come to an end on December 1st. That was largely in line with markets were expecting, with MBS runoff to be invested into T-bills. But I think what was the market moving kind of quote, what came in the presser from Powell, where he basically was saying that a further reduction in policy rates at the December meeting was not a foregone conclusion, and he followed it up saying it's far from it. And this changed the market's pricing for December rate cuts. Heading into the meeting, market was handicapping about 95% probability of a rate cut at the December meeting, and this dropped to currently, I think we're right around 60% probability of a rate cut at the next meeting. And I think it's really just Powell trying to put some optionality back into the market. He doesn't want to be seen as being on like a preset course for rate cuts. And he made it, sound like it's going to be largely dependent on the incoming economic data that
whatever they can get.
Whatever they can get. It seems, they're going to be relying a little bit more heavily on the private data, ADP, state level jobless claims data. But I think Powell didn't really want to be seen to be on this, preset course for policy response.
There's something I want to add to that. Actually, it's in line with that. It's his job out there is to build consensus in these. We had two dissents, but it seems like clearly it seems like we're going to have some challenging some votes in for the December meeting. But he just spoke about the strongly differing views about the December meeting. Like, they've already talked about December, and December is clearly not on the table. I mean, they say that's, again, the quote was strongly differing views about how to proceed in December. So I definitely agree with what you're saying there. It should make for an interesting at least set of minutes.
Yeah. So after the immediately after that, those quotes from Powell, you saw the yield curve kind of bear steepen. Saw the 2-year rise up to, I think it was 360, a 360 handle. The 10-year got well above 4%, up to 410 at some points. And it's just the market pricing in kind of a higher terminal rate for policy. Also led to a bit of a dollar rally as well.
Hey, there's two other things I want to mention from this that are at least giving Powell's perspective or the committee's perspective, and it was specifically talking about the two major mandates, the employment and the inflation. And on the inflation side, it was interesting for him to say that excluding the impact of tariffs, they're estimating core PCE to be in the ballpark at 2.3 to 2.4%. So not that far from the goal. Assuming these are one-time events with tariffs, one-time price shock, that's pretty constructive, at least on a forward-looking basis. You still have to deal with the risk that the ongoing pressure from tariffs can unanchor expectations, but inflation expectations, but they weren't speaking as if that was the case. I mean, everyone has confirmed it or been reaffirming that inflation expectations still are anchored. And the other side is, just again, reaffirming the, at least from Powell's perspective, because there is a differing set of views there, but that rates, he doesn't think they're accommodative. He just thinks they're less restrictive. So I think those are the two mandates of the Fed. It was nice to get some additional color from his view. And I figured that was, that they don't see weakness in the job market accelerating. So it's pretty positive from that perspective.
Yeah, it makes sense. Just, get into this wait and see approach, add some optionality into your scenarios.
Yeah. Anything else we want to cover from this week's eco data? I know it's light with still most of it.
I think the only things I would like to highlight are on Tuesday, we got an update on consumer confidence from the conference board for October. It inched down slightly, down a point to 94.6. Improvement in consumers' assessment of current conditions was offset by a deterioration in consumer expectations, and consumers' kind of sentiment towards the labor market was little changed from the previous month, but it still remains at near cycle lows, and outside of the depths of the pandemic, it's at the lowest levels since 2017. So I'd say rather kind of consumers' assessment of the labor market is pretty poor at the moment. I think another interesting takeaway from the October report as well was, we keep hearing about this, K-shaped recovery where, the higher income earners are doing much better than the lower income earners. And you're seeing this across, like prime versus subprime in ABS, and on the, bank credit card spending, seeing, heftier spending, more robust spending from the higher income cohorts, and much more subdued amongst the lower income cohorts. And we saw a similar kind of theme in this month's consumer confidence report, where they mentioned that consumers making less than 75,000 K a year, they saw a pretty significant decline in expectations, while consumers making more than 200K saw an overall improvement. So that kind of just feeds into this K-shaped narrative. Also, we got home prices from the S&P Totality Case-Shiller release, and bring this up and it's from August. It's a bit of a lagged data release, but it showed a positive increase of 19 basis points month over month, which was the first positive month over month number in 5 months. That being said, though, the year over year pace ticked down to 1.6%, which was the lowest run rate since July of 2023, and well below the pre-pandemic growth rates. So this kind of feeds into that disinflationary narrative on the inflation side that we've been highlighting on these calls over the past couple quarters. And then finally, just would mention, we don't get the jobless claims data at an aggregate level given the government shutdown, but we do still get most of the state based jobless claims data. And if you aggregate this up, it's indicating that we actually saw a downtick to jobless claims for the week of October 25th, down to an estimated 218,000 on a seasonally adjusted basis. So again, this kind of feeds into the narrative that, while we're seeing a, low hiring environment, it's not really leading to significant firings. We're not really seeing an inflection higher in layoffs. And that really wraps it up on the economic front.
Cool. And you know what? Let's recap what's going to happen, or I guess give a preview for what's going to happen next week. Most of this data will not get released, but there are a couple ones to look out for. We have ISM manufacturing on Monday for the month of October, estimated to still come in contraction territory. Last time we saw expansion there was in Jan and Feb this year. JOLTS job openings, unfortunately, not expected to come out, but we do get the ADP private employment report for October, estimated to come in at a positive 27K versus last month's negative 32K. So one of our one of our top tier labor data points nowadays. On Wednesday, we also get the ISM services for October, estimated to remain in expansionary territory. We also get challenger job cuts on for the month of October on Thursday. No estimate there, but prior was 54K. I like to keep the focus there on private numbers, not the combination with the government. We're supposed to get a lot of labor data, the U3, the household survey, the non-farm payroll. None of that is expected due to the government shutdown. So we'll close up the week with the University of Michigan. We get sentiment data and their inflation expectations. We'll see what comes out there. And that wraps it all up for the week.
Yes, thank you to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
And you can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/DoubleLineCapital. We have Jeffrey Gunlock's CNBC appearance post FOMC this week, as well as Ken Shinoda's interview on Bloomberg TV. It also followed the FOMC. Thanks for tuning in, and I hope everyone has a great weekend.
Take care. Have a great weekend, everyone.